Sudan faces a number of macroeconomic policy-making challenges in the coming few years. These are in the context, of course, of political crisis, first in South Sudan and then in Darfur. And Darfur, civil conflict that erupted in 2003 and led to over 200,000 deaths and 2 million or more persons displaced, has yet to be resolved, and in 2007 all signs are that the violence is escalating. In southern Sudan, the civil war that had lasted almost 50 years ended in 2005 with the signing of the Comprehensive Peace Agreement that calls for a referendum in 2011 where southern Sudan might vote to become an independent state. In the interim period, the government of South Sudan enjoys considerable autonomy from the government of northern Sudan, but they share management of the macroeconomy in a government of national unity. Those political crises set the context for macroeconomic policy making, and it's important to remember that it'll be easier to resolve those political crises and have a smooth transition to 2011 when the referendum will take place if macroeconomic policy making in Sudan is good rather than bad macroeconomic policy making. So the top three challenges facing the country are good challenges in the sense that they derive from the importance of oil revenues that the economy is generating. Sudan started exporting oil in 1999 and is currently exporting about 500,000 barrels a day of petroleum. Has proven reserves of about 6 billion barrels. The exports generate about $4 to $5 billion a year for the regime, and late in 2007, as the price of oil has risen, it looks likely that those revenues will increase, at least over the short term. So the macroeconomic policy-making context is a good one. Nevertheless, there are challenges, and the challenges are three. The first is to prevent the export revenues from oil from feeding into the economy and generating high inflation. The second is related, which is to prevent the adverse consequences of the boom that typically follows oil exports into generating an overvalued and appreciated exchange rate, an appreciated real exchange rate, which then causes the export-oriented sector of the economy, the non-oil export-oriented sector of the economy, to experience contraction and productivity decline. The third problem is that there's a strong temptation, given the value of oil exports and reserves, to borrow from the private markets to finance continued economic activity and investment in the country. Sudan already has, however, approximately $27 billion of loans that are in pretty much in default. Sudan has not been making other than good faith payments on those loans for the last 10 or 15 years. In order to work through the mechanisms of the International Monetary Fund and the World Bank that will deliver relief and restructuring of that $27 billion debt overhang that the Sudanese economy has, the Sudan government will have to resist the temptations to borrow using the exports and reserves as collateral on those loans. Let's talk a little bit about inflation in Sudan. Sudan has a short-term history of high inflation from the period 1985 to 1995. Inflation was very high, reaching peaks in the early 1990s of 130% a year. And because of that, the Central Bank of Sudan, the Bank of Sudan, has little monetary policy credibility in the country. Households and the firms are all too willing to believe that in a time of macroeconomic crisis or decline in oil prices, that the central bank might resort again to inflation financing in order to finance government budget deficits. So the monetary authority doesn't have much credibility. That credibility is not enhanced by the frequent currency reforms that Sudan has undertaken, including the most recent one as a result of the comprehensive peace agreement, where the country switched from the dinar, which was widely circulating in northern Sudan, to a new version of the traditional Sudanese pound that will now circulate in northern and southern Sudan. So the monetary authorities lack credibility, and it's very difficult for them to commit to a credible macroeconomic policy. The oil revenues that are generated by the government spending boom typically lead to increases in the demand for money to finance all of the economic activity that's generated by the boom, and then it also typically leads to sectoral price increases, particularly in the urban construction and urban services sector. The central bank has to accommodate that enormous increase in economic activity by expanding the money supply, by allowing the commercial banking system to increasingly intermediate economic activity. But there's always the danger that they're too loose in allowing the commercial banking sector to expand, so they need to be carefully accommodative of the expansion and real demand for money in the economy. They have a real danger if they start generating or allowing too much credit creation, that feeds through into a general price increase instead of just a sectoral price increase. And then when there is a drop in the price of oil, an oil price shock, the government committed to a high spending pattern resorts to using monetary policy as a way to finance a large government budget deficit. Then the economy would be locked into a high inflation, low output growth scenario, a stagflation type scenario. Quite a number of African countries have experienced that over the years, and it's one of the biggest dangers of macroeconomic policy, of bad macroeconomic policy making. The other danger that I mentioned before is the danger of an excessive real appreciation of the real exchange rate. And that can take the form either of a general price increase in the context of a fixed exchange rate, or it can take the form of an appreciation of the nominal exchange rate. And this is a tricky, very tricky macroeconomic policy issue to handle. The government needs to avoid having the non-oil export sector, which in Sudan is primarily the agricultural sector, the irrigated farming schemes of central Sudan that grow a lot of cotton for export, and the small industrial sector that processes that cotton, and the rain-fed agricultural sector that produces agricultural commodities for export, such as oil seeds like groundnuts and sesame. The government needs to ensure that those sectors don't decline precipitously as a result of higher wages and higher prices in other sectors, higher returns in other sectors, primarily urban services and urban construction sectors. The livestock sector is another sector that might be adversely affected by the appreciation of the real exchange rate. This is a tricky issue because if the Sudan government allows the exchange rate to float, then capital inflows that come from using the oil export revenues and the oil reserves as collateral will likely lead to a rapid appreciation of the Sudanese pound and then a crowding out of these export sectors. On the other hand, if the government keeps a managed float that turns into a fixed exchange rate for the Sudanese pound, then they run the danger that as domestic inflation rises, the pound quickly becomes in need of a depreciation, and that might generate a balance of payments speculative attack. The reserves that the central bank has might not be sufficient to defend the pound, and the macroeconomic crisis that ensues, if it turns into a banking crisis, will lead to a very sharp decline in output. So those are some of the main policy-making issues that the government faces in terms of monetary policy. Related issue is, of course, as I mentioned earlier, the Sudan has this debt overhang of $27 billion, and one of the conditions for eventually restructuring that debt is that the government and government entities can't be taking on new debt at commercial rates. The government of Sudan presently is doing precisely that, is borrowing from China and from India in order to finance large infrastructure projects such as the dam construction project on the Nile, refinery projects and other water projects. So those loans that are taken at non-concessional rates imperil the government's eventual ability to restructure its concessional loans that it's taken from the World Bank, the IMF, and other entities. That's another issue that the government has to be careful to avoid. Finally, let me say a couple words about macroeconomic policy making in Southern Sudan, which I think is quite different from the issues that North Sudan faces. In North Sudan, the monetary authorities have to be careful in not allowing the domestic credit sector to expand too rapidly. South Sudan has almost no capacity and will have $2 to $3 billion worth of oil revenues to spend. Most of that then will be spent on imports and outside consulting services as infrastructure, schools, roads, hospitals are built in the south. There's a real danger, however, that ordinary people will face a continued credit crunch. That is, a lack of availability of credit out in rural areas and small towns. In South Sudan, the government wants to be fairly aggressive, it seems to me, in promoting small-scale financing, microfinance, and really small enterprise finance. So that logic for the south of Sudan of rapid expansion of commercial, of a very small-scale commercial banking sector that won't be able to meet the regulatory standards of the big urban banks in Khartoum seems to me one of the main policy challenges that South Sudan faces in the context of having its monetary policy and banking regulation policy set by the government of national unity, that is, set primarily with Khartoum in mind. So those are some of the macroeconomic policy issues that Sudan is facing in late 2007.